everybody, and welcome back to the Financial Wrap. It's been a while, but it's really good to be back today. Really interesting times in the investing world right now. We have a whole bunch of stuff going on. A lot of things on the agenda today that I want to talk about. The first thing is just the overall investing landscape and kind of what's happened since I last spoke on this show. Interest rates, because it wouldn't be an investing podcast unless I mentioned interest rates. I will be talking about the ongoing strikes, both in Hollywood and now also in the auto industry, as well as I'll be mentioning the government shutdown that is probably going to happen. This episode will probably be released right before the deadline. But right now, at the time of the recording, at 1:52 p.m. Central Time on 9/29, it is looking like a government shutdown is imminent. And then I'll be shifting gears and talking about some investments that I'm interested looking at, maybe some moves that I'm making, and then at the end, just some parting advice before I leave this episode. So, really excited about this one, and let's get right into it. So it has been a few months or so, a couple weeks, a month or so since I last spoke on the show, and the overall investing landscape has varied slightly. I'm pulling up a chart of the S&P 500 right in front of me, but we have generally rallied since really since October of last year. We've been rallying. We got as high as about 46.05 on the S&P 500, and we've kind of been correcting since then, and we're actually moving our way back down towards the 200 day moving average, which was really pivotal in the change of trend from the bear market we saw in 2022 to the rally that we've been seeing up until today. So we are still in that uptrend. We have been correcting a little bit, which is normal. I think the overall lesson throughout this period, though, has been that it pays to stay invested and not really go all to the sidelines. There are a lot of people who were kind of staying away from this market, especially near the bottom of the market, saying that we needed further capitulation. I know myself included, I definitely thought the market could have gone lower, and I was convinced that it probably was going to go at least a little bit lower, but that didn't stop me from staying invested. I was always dollar cost averaging, and I kind of think that this past time period has been a testament to that, it pays to stay invested. Not only did I capture the capital gains appreciation that's happened since last October, but because I've stayed invested, I've still been collecting dividends and compounding the amount of shares that I own in my main portfolio. So I think that that's important for a lot of people to hear, because the media will always be pushing to you what's going to get the most views or the most clicks, and you can't always actually you should never base your investment decisions off of any type of media, including my own show. You should always look at your own personal situation, and there's a lot that goes into that. But I do believe that it pays to be invested over the long term if it makes sense for you. Now, I guess I should mention some things that would go along with your personal situation that would play into that. I know the two big main ones for most people is how much debt you have on your own personal balance sheet, and then how much cash you have. So if you have a large amount of outstanding debt, especially if it's at a higher interest rate, you should definitely be looking at putting money at that and paying down your debt, because whatever the interest rate is on that debt, you're basically guaranteed that rate of return on the money that you are paying down on that principal. So I would definitely say get your debt under control if that is something that is applicable to you. Also, how much cash you have on hand. I'm definitely someone who believes you shouldn't save in cash, but I think it's really important to have your expenses, not only for the current month, but for future months, maybe even years, if that's what you feel comfortable with, saved in whatever currency that you're going to pay them in. Personally, I would like to have in my own emergency savings account at least a year of expenses in dollars because I live in the U.S. dollars. Um, I know some people say, 3 to 6 months is good. I would personally like to have at least a year, if not 2 to 3 years. I think anything further than that is a little bit excessive, and you're maybe giving up a little bit too much of an opportunity cost as opposed to investing that cash. But I think it definitely pays to have some emergency savings. You never know what's going to happen. You never know if you get disabled or something happens. Obviously, you hope these things don't happen, but it definitely is prudent to be prepared for these things to happen. And I'm in no way yet to that amount of emergency savings, but that's definitely the target that I would be going for. And I'm still invested in the markets because I do all these things at the same time. I know some people would say to pay down your debt first and then start investing or saving your emergency fund, but I've kind of found in my own experience over the past couple of years that it pays to save in all types of areas at the same time. So I'm paying down my student loans, I'm building an emergency fund, and I'm actively investing in the market all at the same time. And I think that that's definitely been the right decision for me. That doesn't mean it will be the best decision for you. Um, I think kind of to wrap up this segment though, patience is really the key. I think especially in investing, patience pays. It pays to be patient in the market. You never want to jump the boat too quick and sell when the market's dropping and wait for a lower price to get in because that usually doesn't work out. And you also at the same time don't want to go chasing big rallies. Look at Nvidia. It was definitely tempting for people to buy that rally. And if you did, it hasn't paid off yet. I mean, depending on where you got in, but the probability that your future returns will also be that great are pretty low to none. So I think patience is key. Understanding the fundamentals along with the technicals, but at the end of the day, the fundamentals is what's going to drive the asset. And not acting on emotion or just jumping into a fad. I think that was something that I also took away from the last couple of months because there's been a lot of that, especially in AI as a fad in the other direction to the upside. You don't want to chase those rallies all the time the same way you didn't want to sell the market when it was at its low back in October. So let's move on now to interest rates. Interest rates have gone slightly higher than people might have been anticipating at the beginning of 2023. Personally, I was expecting rates to go higher, and I still expect them to stay this high, if not 25 basis points higher for an extended period of time. Maybe even into Q2, Q3, 2024 with no rate cuts. But that's really dependent on nothing in the financial system breaking. I think if something breaks, which is definitely possible for something to break before that time period, then I think the Fed will have no choice but to start easing these rates and cutting a little bit. But I think it's in their best interest to keep them higher for longer. Inflation's still well above their 2% target. And their only two mandates are unemployment stability and price stability. And if you don't have price stability, but you have employment stability for the time being, they don't really care about stock market prices. The Fed does not care about corporate profit growth, corporate revenue growth. They don't care about any of that, or at least they shouldn't. And so I think they really don't have a choice but to keep them high until either something breaks or until inflation comes down. And as much as that sucks, and that's not always the best outcome for the people living in this country, that's the reality of our economic situation, and that's why maybe our economic landscape will look different in 20 years than the way it looks now. That's all I really want to say regarding rates. I think the bigger issue is really the debt spiral that you could argue we're already in. I don't really know how the average American pays down their debt whether it's mortgage, credit cards, student loans. The average American will never be debt free. The government probably will never be debt free, with short of a complete collapse of the system, which obviously is not good either. Um, and I think eventually that's gonna have to be addressed or reach a breaking point. You know, we're at unprecedented levels of GDP um, to debt ratios, and I don't think that's sustainable. I don't really think anyone who understands finance thinks that's sustainable. I think that's the bigger issue than what how long rates stay high, in my opinion, because that's an issue that just keeps spiraling no matter where rates are at. So that's all I'll say about that. You know, everyone wants to hear about interest rates, so I thought I would throw that in there. But let's move on to the strikes now, because that's kind of been a recurring theme now in the US, and I think it goes deeper than just what people are talking about right now. I mean, minimum wage federally has been the same for a long time in the United States, and in that time, prices have gone up, inflation's gone up, especially the past 3 years. Uh, and I think the average worker sees that the company they work for is posting record profits year after year, yet their wages are going nowhere. And in fact, their real wages are going down when you take into account inflation. And they're sick of it. I think it's to be expected. And I think if you're an investor and you're being affected in a negative way uh, by these strikes, I don't think it's something that you should be angry at the people who are striking. This is something that's necessary. A healthy economy needs workers to be paid fair wages. We need people to be on living wages to have a sustainable society. I think you have to put your political opinions to the side and just zoom out a little bit and understand that you cannot have a sustainable economy or a sustainable society when people are working full-time jobs or multiple full-time jobs and are not making a living wage. At that point, you have to put your political alliance to the side and understand that people should be paid fairly. So, um, whether it affects the stock market negatively or positively, I don't care. I think I want these people to be paid fairly because I think in the long run that'll benefit society and it will benefit the economy, and that of course will be reflected in market prices if that's the angle you want to take at it. So um, I hope that the workers get what they deserve, and I hope that it doesn't go on for longer than it needs to, because that will hurt the markets more than it necessarily has to. But at the end of the day, I hope the workers do get paid what they are entitled to. We've seen some pretty steep raises for the groups of unions that have already gone on strike. We saw the UPS or the FedEx workers, I forget which one it was, they were making over $100,000 a year. I know that the automobile workers are looking for something up to like a 40% raise at least. So I'm interested to see how this affects other areas of the labor market. If there are going to be more groups that go on strike, it wouldn't surprise me, or just if in general the average American's going into their place of work and asking for a higher wage, I wouldn't be surprised about that either. Um, and I think it is time, because regardless of what the inflation narrative is, when you have record net incomes, record profits, record revenues for the companies, and record pay packages for the executives, I think it's only fair for the laborers to also have their wages reflect those gains. So that's all I'll say about that too. I definitely don't want to make that political. I just think, I mean, it's only right. How would you feel if you were working full time and couldn't afford your basic expenses? I think that's just not sustainable. So something to think about. But we'll move on to the government shutdown, because that is also going to affect the economy and millions of government workers. So overall, a government shutdown definitely wouldn't be good for markets, as there'd be a number of industries that would be immediately disrupted. The main big one I'm thinking about is air travel. TSA agents, the people that work on the tarmacs, air traffic control, that's all government workers. And these government workers, well, the teams will be stripped down to skeleton crews, but the people who are being asked to work are not going to be getting paid. So you're going to have people who either continue working their government job for no pay for an undisclosed amount of time, or they quit or start working somewhere else in the meantime, and these jobs go vacant and things get shut down. So that'll be interesting. Obviously, the government hasn't shut down yet, but at the time of this recording, it looks like the government will go into a shutdown. And I think a lot of eyes will be looking to see how long that'll take. There's a lot of Americans, the majority of Americans right now are living paycheck to paycheck. So the 3 million people that are employed by the government, at least a million five of those people are going to have no choice but to find another job that they can actually get paid at during the shutdown. So I think that definitely affects the economy and it affects the markets if it's ongoing. So hopefully it's short lived. I mean, I tend to believe that it will be because it's an election year, but you never know. We live in crazy times. So let's move on to my favorite segment, and I'll talk about some investments I'm looking at, interested in, and maybe some moves that I'm making. So I just want to start out by saying that I'm always dollar cost averaging a base amount into all of my investment accounts, and I'm always building my cash because I have not met my cash reserve goals. And I'm paying down my debt because I've not finished paying down my student loans yet. So those are three things that no matter what the stock market is doing, those are three things that I'm always doing. Also saving for a house at some point, so that would be included in my building my cash because that cash will eventually be allocated towards real estate. So those are three things I'm always doing no matter what the market condition is. However, in this market condition, the main thing I'm looking at, and really my highest conviction for the future, is still Bitcoin. Um, so many reasons. I won't get into all of them in this episode because this is not a Bitcoin podcast. This is just a general investing podcast, but Bitcoin remains my strongest conviction investment, and I do have it saved or invested, I guess, in two different ways. So before I get into that, sorry, excuse me, that's my email. Before I get into that, let me break down why I'm so highly convicted in Bitcoin, at least from a general level. So, one, I think our monetary system is unsustainable. You know, we've only had fiat money for some 50 some odd years. I don't think it's sustainable. Our country's in a debt spiral, and the big reason is because the money is broken. Bitcoin is the only asset in the world that is able to be completely secured by any individual on the planet. It's completely censorship free, and you can transact it instantly anywhere in the world for an almost zero fee. And the reason I like it more than gold is because there are things with gold such as security, trust, verifiability, transportation, transaction costs, all types of things that Bitcoin has the complete edge in over gold. Also scarcity. And so for those reasons, I like Bitcoin as a safe haven from any sort of economic chaos that might ensue in my lifetime. Additionally, I think that there's still a lot of money that is awaiting to be invested into Bitcoin. A lot of that will change when the new accounting rules take place in 2025. I think a lot of corporations will now be incentivized to put some of their cash in Bitcoin. And additionally, I think once a Bitcoin ETF is approved, which I'll talk about in just a moment, I think that will also allow a much larger amount of money go into the Bitcoin market that has been waiting on the sidelines. So I'll kind of cut it there for why I'm convicted into Bitcoin, but the ways I'm investing in it, the vast majority, maybe like 95% of the money I have invested in Bitcoin is in a wallet, and that's all I'll say. And it's somewhere, maybe, and that's how I invest in it. and the remaining 5% I have in my trading account in the form of GBTC. I started building up my position when the discount on GBTC to the Bitcoin that they hold in the trust was around 40%. And the price of Bitcoin at the time was around, I don't know what it was, maybe around 21,000. So maybe the discount wasn't that steep. Maybe it was like 38%. But regardless, it was a pretty steep discount, and the price of the Bitcoin was cheap. Since then, I've added to my position. I'm up some 30% right now, but I do expect to hold on to it at least for the next, let's call it 3 to 5 years. I do expect their ETF to be uh, confirmed, accepted, put through by the SEC. And when that happens, the discount will be immediately wiped out. I also think that'll push the price of of Bitcoin higher, much higher than it is right now. And for those reasons, I like the risk to reward ratio I can get in my trading account by buying a certain amount of shares in GBTC. So I am really, really convicted in Bitcoin. I am investing in it. Overall, I'd say the Bitcoin positions make up about 7% of my portfolio, so still nothing crazy. But it really is one of my highest conviction investments, and I'm excited to see it play out over the next 5 to 10 years, but really my whole life. So I'll kind of stop there with Bitcoin. Another move I've made though is I am holding on to my ARK investments. I do hold ARK K, ARK G, and ARK W, and that's just the main ARK K, the ARK Innovation Fund, and then the Genomics Fund and the Next Generation Internet Fund. I do still hold them. Together, all three of the funds make up maybe around 3.3-ish% of my portfolio, so nothing huge, but definitely a acknowledgeable amount. I'm not allocating to it anymore because of the drawdown that I see in the businesses that she invests in. But I am not selling because this is way too cheap for me to sell, one. And two, I definitely still believe in the investment thesis. I just think maybe it belongs slightly less allocated or a slightly less allocation in my portfolio. So I am no longer allocating. I'd say the bigger reason though is because maybe the mistake I made was the price I started my position at. I think my average price is maybe like $80, $79 on RK. Right now it's trading at like $40. The high is at like $160, but so I am like 50% from the top. The high is my average cost, but I'm down like around 50% again for my position. So obviously not a great investment. It doesn't make up a huge part of my portfolio, and my portfolio has still been outperforming the index by a pretty significant margin. But that is a move that I've started making. And, I'm not afraid to admit my mistakes because that is when I learn the most. And honestly, it reaffirmed having a diversified portfolio because I'm still outperforming regardless of being down 50% in my ARK innovation position. So, last thing I kind of wanted to talk about because the thought process of being invested, I don't know, in these different types of ETF funds kind of got me thinking in this path, but just market weighted index funds are literally a cheat code. This hasn't always been an investment vehicle available to the public, especially for, I mean, 0.02% fees on like VU, the Vanguard ones. That's ridiculous. You can hold a market weighted index for your entire life and be fine. And the reason that is because just naturally speaking, the losers will become smaller and smaller and will affect the portfolio less and less, and the winners will become bigger and bigger positions, and you'll feel the gains more and more. And if a company goes bankrupt or something like that, they get replaced. You don't have to do anything. And I just think for the average investor, it's such a cheat code to be invested in a market index. I think like 68% of my entire portfolio is in a variety of index funds, just like passive ones. And I think that's a huge advantage, and I think that people should use that to their advantage. Um, Last thing I'll say, stay vigilant out there. Don't let the noise get to you in the investment media. Stick to your plan. Be prudent, be responsible, understand the fundamentals in your investments, and don't go chasing the fads, and don't trade on emotion. Be patient. So I'll leave it there. Thank you for listening, and I'll see you next time.